So our lesson for today is still on the inventories, accounting for inventories, but specifically on the lower of cost and net realizable value or LC NRV. So how do we measure the inventory? So accordingly, the measurement of the inventory should be the lower of the cost and the net realizable value. So this is according to PAS2 inventories wherein we shall measure our inventories, whatever type of inventories, at LCNRV. So when we say lower of cost and net realizable value, so we're going to choose which has the lower amount between cost and the net realizable value. So the lower between the two will be the valuation of our inventories at year end. We already know what is cost, so it will include the purchase price and other directly attributable costs to bring the asset to its present condition or location. And we also had the um, inventory cost flow methods that will help us determine how much would be the valuation of our inventory according to cost. So katong ato ang ma-derive na amounts using either FIFO, periodic, perpetual, or weighted average, periodic, or moving average. So whatever amount that we will derive from that, that will be treated as the cost. And we're going to compare that with the NRV or the net realizable value. So what is a net realizable value? So to compute the net realizable value, we're going to get first the estimated selling price in the ordinary course of business and then deduct the cost of completion. So if the inventory needs to be completed in order to be saleable, then we will deduct the cost to complete or cost of completion. And aside from that, we're going to deduct the cost of disposal or cost to sell. So the total amount from these deductions, we will deduct that from the estimated selling price. And that is how we're going to get the NRV. So the cost of inventories may not be recoverable. So dili na nato siya ma-recover under the following circumstances when the inventories are already damaged. The inventories have become wholly or partially obsolete, or the selling prices have declined. And lastly, the estimated cost of completion or the estimated cost of disposal has increased. So the practice of writing inventories down below cost to net realizable value is consistent with the view that assets shall not be carried in excess of amounts expected to be realized from their sale or use. So how do we determine the net realizable value? So the inventories are usually written down to net realizable value on an item by item or individual basis, not on the basis of the classification of inventory, because it will not be appropriate to write down the inventories based on a classification of inventory, for example, finished goods or all inventories in a particular industry or geographical segment. In some circumstances, it may be appropriate to group similar or related items, for example, those relating to the same product line that have similar purposes and are produced and marketed in the same geographical area and cannot be practically evaluated separately. Aside from that, materials held for use in production, these are not written down below cost if the finished products in which they will be incorporated are expected to be sold at or above cost. However, when a decline in the price of materials indicates that the cost of the finished products exceeds the net realizable value, the materials are written down to net realizable value. In such cases, the replacement cost of materials may be the best evidence of the net realizable value. So it was mentioned in the previous slides about writing down our inventory. So writing down of inventories happen if the cost is greater than the net realizable value, and we have to bring down the cost to the net realizable value. So again, inventory write down happens if the cost is greater than the net realizable value, and we need to bring down the amount from cost to the net realizable value. Remember that the rule is we're going to apply LCNRV, so lower between the cost and the net realizable value. So if the net realizable value is lower, then we are going to write down the inventories. So if the cost is lesser than the net realizable value, so what would be the treatment? Inventory will be measured at cost, of course, because accordingly, LCNRV, the lower between the cost and the NRV. So since the cost is lesser, so the cost will be used as the measurement of our inventory. And take note that this is already the amount that we have recorded in our books. So there will be no accounting problem and there will be no more adjustments because it's already at cost or at the lower between the cost and the net realizable value. So no more adjustments to be made. Again, because the records in our books are already at cost. So, increase in value due to the net realizable value, di ba, mas greater ang net realizable value, is not recognized. Therefore, again, there will be no adjustments. Dili na to ipa-increase ang inventory. It will be recorded as is, as what we have previously recorded. What if it's the other way around and the cost is greater than the net realizable value? And as a rule again, if it is LCNRV, we're going to choose the lower amount. So if this is the case, then the net realizable value is a lower amount. So therefore, the inventory will be measured at net realizable value. Therefore, we need to adjust the cost and bring it down to the net realizable value. That's why it's called as inventory write down. And as a result, there will be a decrease in value from the cost down to the net realizable value, and that will be recognized. So there are methods in accounting for inventory write down. So we have two, the direct method or the cost of goods sold method, and the allowance method, or it's called as the loss method. In the direct method or the cost of goods sold method, the inventory is recorded at LCNRV. So automatic, when we prepare the entry, we're going to record it at the lower between the cost and the net realizable value. Any loss on inventory write-down or gain on reversal of inventory write-down is not accounted for separately. So therefore, we are not going to record any entry for the write-down, but it will be buried in the cost of goods sold. The second method is the allowance method. The inventory will be recorded initially at cost, and then afterwards, we're going to prepare a separate entry for the loss on inventory write-down, or if there is a gain on reversal of inventory write-down, we're going to recognize that as well. The journal entry for this one would be loss on inventory write-down and allowance for inventory write-down. If the required allowance increases, then we will recognize additional loss. So additional loss on inventory write-down and credit allowance for inventory write-down. If the required allowance decreases, so this is the other scenario, record gain on reversal of inventory write-down. However, the gain is limited only to the extent of the allowance balance. Preferably, the allowance method is used in order that the effects of write-down and reversal of write-down can be clearly identified. PAS2 requires disclosure of the amount of any inventory write-down and the amount of any reversal of the inventory write-down. So we have the first example for the inventory write-down. It's the same with the information found in your books. So this is on December 31, 2020. We have the column for the cost and we have the column for the net realizable value, and we have the categories of our inventories. We have category 1, category 2, and then category 3. What if we're using the LCNRV item by item or individual basis? So if we're using item by item, so we're going to look at each of the inventories and compare its corresponding cost and NRV. So tagsa-tagsa by item or individual basis. So we'll start with category 1. This is our inventory A. So we will choose the lower amount. So the lower amount is 100,000. For category 1B, the lower amount is 690,000. For category C, the lower amount is 600,000, which is the cost. Next, we move on to the next category. So you have inventory D. The lower amount is the net realizable value, which is 1,900,000. And for inventory E, the lower amount is our cost at 1,500,000. For category 3, F, the lower amount is 1,460,000, which is the NRV. And for inventory G, the lower amount is the cost 1,600,000. So if we're going to sum it up, all of the lower amount between the cost and the NRV for each item, okay, so we will get 7,850,000. Again, that's for the item by item or individual basis. Now, let's proceed to the next one. What if we account it by category? So, therefore, we are going to get the total for each category. So, which of the two is lower? Is it the total cost or the total NRV for category 1? So, we're going to choose the lesser amount, which is 1,400,000. So, therefore, for category 1, the lower amount is 1,400,000. That will be the valuation for the category 1 inventories. Next, under category 2, the lower amount is 3,460,000. So then we take note of 3,460,000 as the lower between the total cost and total NRV for category 2. For category 3, the lower amount is 3,100,000. So therefore, that will be the valuation for category 3 in total. So we're going to sum up these 3 categories. The total would be 7,960,000. So that will be the valuation of our inventory if it is by category. If we're going to use the total, by total, ang pagpili or ang pagdetermine sa LCNRV, then we're going to choose the lower total, which is 8 million under cost. So therefore, the valuation of the inventory would be 8 million. So it depends if what is the specific na LCNRV that will be used by the company. Is it by item? Is it by category? Or is it in total? Or some other groupings that are acceptable or allowable by PAS2? Assume that the inventory is valued LCNRV on an item-by-item basis. So again, our cost is 8 million if we're going to get the total of all the costs. The NRV is 7,850,000, and based on the rules, if the cost is greater than the NRV, there is an inventory write down, because we are going to reduce the 8 million and make it 7,850,000. That's why there would be an adjustment for inventory write down. So using direct method, di ba, as a rule, we're going to record it at the LCNRV automatic. That's why on December 31, the amount is 7,850,000, and then credit income summary 7,850,000. So the loss on inventory write-down of 150,000 is not accounted for separately, which means we don't have a separate entry for that transaction. The entry will have the effect, this entry will have the effect of increasing the cost of goods sold because the NRV is lower than cost. Kaya gamay naman na itong pang-deduct, di ba? The inventory N is a deduction to get the cost of goods sold. So if the deduction, which is inventory N, is lesser, it will result to a greater amount of cost of goods sold by 150,000. Next is if we're using allowance method, so the entry would be at cost. Initially, there will be an entry at cost, and then we're going to make an adjustment for the loss on inventory write-down, which is accounted for separately. Again, when we say we accounted for separately, there will be a separate entry to record the transaction. So that's loss on inventory write-down and credit allowance for inventory write-down. So the loss on inventory write-down is included in the computation of the cost of goods sold. And the allowance for inventory write-down is presented as follows. Inventory on December 31 at cost, 8 million. Allowance for inventory write-down of 150,000. And the net realizable value is 7,850,000, which is the lower amount between the cost and the net realizable value. So let's continue the illustration. So these are the items that we have identified previously in 2020. Assume that on December 31, 2021, which is the following year, the following data are available. So what would be the entry using direct method? So record the inventory at the lower amount, which is 8,400,000, and credit income summary 8,400,000. Using allowance method, okay, we're going to determine the cost on December 31, which is 8,500,000, and the net realizable value is 8,400,000. So there is a required allowance of 100,000. So since we already recognize an allowance balance in December 31, 2020, so therefore we need to adjust for the difference of 50,000, which is decrease kay required man na 100. So we make this we're going to recognize 100,000, and from 150 to make it 100, so we're going to deduct 50,000. So the entry to reduce the allowance, we're going to debit allowance for inventory write-down and then credit gain on reversal of inventory write-down. So this gain on reversal of inventory write-down is presented as a deduction from the cost of goods sold. Next, we have illustration number 2. We have the following data on at the start of the year, at the end of the year for the inventories, and we have the net purchases. Using direct method, we're going to determine how much would be the valuation of the inventory. So the inventory on January 1, diba, according to the rule, we're going to use the LCNRV if we're using direct method. That's why the inventory on January 1 is the lower between the January 1 balance. So this is the amount that we're going to use because this one is lower. The net purchases will be the same. Then we have the total goods available for sale, and for the inventory N, again, we're going to use the lower amount. As a result, the cost of goods sold is 19,200,000. So note that the inventory beginning or end is presented at lower amount if we're using direct method. If this is allowance method, we will get the required allowance on December 31, which is 700,000. That's the difference between the inventory N, which is 6 million, and the NRV, which is 5,300,000. So this is the required allowance, and we already have the required allowance on January 1. How do we determine that? Get the difference between the January 1 balance at cost and at NRV. There's a difference of 500,000. Since the required allowance on December 31 is greater, we need to make 500,000, 700,000 by increasing the allowance. And if we increase the allowance, we're also going to recognize the loss on inventory write down for the amount of 200,000. So that would be debit to inventory or loss on inventory write down, and then credit allowance for inventory write down. So how much is the cost of goods sold? So we start with inventory January 1 balance. Observe that it recognize the cost and not the NRV, because later on there would be adjustment for the loss on inventory write down. Net purchases is 2 million. Then observe that the December 31 inventory is also at cost. Again, because the loss on inventory write down will be accounted for separately and added to the cost of goods sold. Therefore, the cost of goods sold after inventory write down is 19,200,000, which is the same with the amount we have computed under direct method. So take note that whether you're using direct method or allowance method, the cost of goods sold must be the same. Next, we'll proceed with the purchase commitments. So these are obligations of the entity to acquire certain goods sometime in the future at a fixed price and fixed quantity. So this is a promise to pay. That's why there's a commitment. Promise to acquire, promise to purchase. And this will constitute an obligation. A purchase contract has already been made for future delivery of goods fixed in price and in quantity. Where purchase commitments are significant or unusual, disclosure is required in the accompanying notes to the financial statement. Any losses which are expected to arise from the firm and non-cancelable commitments shall be recognized. If there is a decline in purchase price after a purchase commitment has been made, a loss is recorded in the period of the price decline. Important consideration, purchase commitment must be non-cancelable. Dapat dili siya pwedeng i-cancel in order that a loss on purchase commitment can be recognized. Otherwise, kung cancelable siya, so we cannot recognize the purchase commitment or loss on purchase commitment. Thus, if at the end of the reporting period the purchase price falls below the agreed price, the difference is accounted for as debit loss on purchase commitment and then estimated liability for purchase commitment. Let's look at the example for the purchase commitments. So the contract price is 500,000 and the replacement cost is 450,000. So there's a decline in the value in amount of 50,000. So the market decline of 50,000 is recorded as follows: loss on purchase commitment, credit estimated liability for purchase commitment. Note that the loss on purchase commitment is treated as other expenses, while the estimated liability for purchase commitment is treated as a current liability. When the actual purchase is made in the subsequent period and the current replacement cost drops further to 420,000, yung samot pa siya ka gamay, so we need to make adjustments for the difference. So from 450 it becomes 420. So what would be the entry? Debit purchases, because this is the replacement cost, 420,000. Then we're going to debit first here the estimated liability to close the estimated liability of 50,000 and credit accounts payable for the purchase commitment nga contract price, di ba? 500,000 man tong agreement. So the balancing figure here is the loss on purchase commitment, which is the difference between 450 and 420. Di ba? Hingubos siya further. Just imagine nga ang imuhang kontrata, your agreement with the seller is you're going to pay 500,000 pesos. And it turned out that the replacement cost during the date nga supposed to be magbayad na ta, 420,000 na lang siya. So meaning uh, you have a loss, alkansi ka, di ba? Sa 450,000 pa lang daan na nakay-alkansi nga 50,000 plus samot pa dyan siya kaubos na himo siyang 420,000. So pila na may total nimo nga nalugi adto, that would be 80,000. Lugi because you're going to pay still the original contract price nga 500,000 but the value of the inventory is lesser. So that's why there is additional nga loss on purchase commitment because of the further decrease in the replacement cost. Let's continue the assumption. So again, the contract price is 500,000. And then what if the replacement cost of the purchase commitment is 600,000 when the actual purchase is made? So mas dako pa kaysa sa contract price nga 500,000. What would be the entry? So debit purchases. Okay? So and you close the estimated liability for purchase commitment. So this ama ni siya gikan katong ganiha, di ba? 450 man tong gi-recognize na estimated liability for purchase commitment, if you can recall sa original nga data, di ba? 450, and then pag actual na pagpalit, nahimong 600,000 ang replacement cost. So i-close nimo tong estimated liability for purchase equipment or commitment. Then credit accounts payable, which is 500,000. Then you have your purchases is still 500,000 also. And we have gain on purchase commitment. So the purchase is recorded at 500,000 instead of 600,000 since the purchase commitment of 500,000 is less than the replacement cost. Remember, di ba? Dapat conservative ta. That will be the lower amount. We're not going to buy it at 600,000, no? Kay ang agreement was 500,000, di ba? Safe na ganito taad to, di ba? Kay 500,000 siya no matter what. Kung mahal pa yung replacement cost, wala tayo labot adto. Di ba? Dili na ta mamumlimaan na. We're not going to pay for the replacement cost because we already have this agreement in the amount of 500,000. So the gain on purchase commitment here will be recorded as other income. If the replacement cost of the purchase commitment is 480,000, not 420, not 600, but 480,000, what would be the entry? So that would be debit to 480,000, okay, which is the purchases, or that would be the amount of the replacement cost. So the purchase is recorded at 480,000 instead of 500,000 because the purchase commitment here is greater than the replacement cost. So correction ha, because the purchase commitment is greater than the replacement cost of 480,000. The gain on purchase commitment is the increase in the market price from 450 to 480,000. Again, where do we get the 450,000? Diba? In the original nga data, diba? We have here the initial replacement cost is 450,000. And what if in the actual purchase, it becomes 480,000? So debit purchases 480,000. Then debit estimated liability for purchase commitment, we will close the previously recognized estimated liability. Then we're going to pay 500,000 because that's our purchase price, contact purchase price, and credit gain on purchase commitment. Then, what are the necessary disclosures? So, the accounting policies adopted in measuring inventories, including the cost formula used, total carrying amount of inventories and carrying amount in classification appropriate to the entity, carrying amount of any inventories carried at fair value less cost to sell, amount of any write-down of inventories recognized as expense, and also any reversal of the write-down to net realizable value recognized as income. Also, the circumstances that led to such reversal, carrying amount of inventories pledged as security for liabilities, and cost of inventories recognized as expense. Then, how about the agricultural, forest, and mineral products and commodities of broker traders? So, for products or for producers or producers of agricultural and forest products, agricultural produce after harvest, and mineral products to the extent that they are measured at net realizable value in accordance with well established practices in those industries. When such inventories are measured at net realizable value, changes in that value are recognized in the profit or loss in the period of change. So accordingly, agricultural crops that have been harvested or mineral products that have been extracted are measured at net realizable value when a sale is assured under a forward contract or government guarantee, or when a homogeneous market exists and there is a negligible risk of failure to sell. For products that are sold by commodity brokers and dealers, they measure the inventories at fair value. When such inventories are measured at fair value less cost to sell, changes in fair value less cost to sell are recognized in profit or loss in the period of the change. So, who are these broker traders? They are those who buy and sell commodities for others on their own account. The inventories of broker traders are principally acquired with the purpose of selling them in the near future and generating profit from fluctuations in price or the broker trader's margin.
If you like this video, don't forget to click like, subscribe, and hit the notification bell to be updated with the latest video lessons. Thank you for watching.